Cool. So today I just want to talk about something we've touched on in the past and something that basically if you don't understand it or don't use it, you're going to have an extremely low hit rate. And it doesn't matter. I mean, if you're trading price action, right? If you're trading anything to do with market structure, anything to do with points of interest, order flow, ICT, supply and demand, whatever. In my opinion, if you don't understand this, then you're just going to be fucked in the long run. You might make it for a little while and you might get some wins, but over a long period of time, your consistency is not going to be there. And that is displacement and understanding where to look for it, when to use it, and how to use it, and not only getting bias and entries, but just overall, just kind of instilling it into your perspective to only really pay attention to structure that results from displacement or results from displacement and liquidity being taken. Um, now, I think that whenever everybody first gets into trading, smart money or anything to do with really market structure, you kind of look at every single high and low, and you're like, damn, like what is the structure? There's like we went over a lot of different types of structure mapping. I've tried different stuff. I've tried the strong high, strong low, swing high, swing low, internal high, internal, and the more and more that I trade, the more and more I see that if you want consistency, you don't necessarily pay attention to each high and low. Here's a great example right in front of us. So if we look here, you can say here's a high, sorry, here's a low, here's a high. Some people map all this, some people don't map anything till this high is broken. That's how I used to map structure. And it has you looking left so much, and you're always just, okay, strong high, strong low. And you can see that in this example, some people, if you don't use candle closes, you might have said, oh, well, it made a new high right here, low, high, and this is a pretty obvious one. I think a lot of people wouldn't have mapped this, but this principle is what causes people to, get kind of end up on the wrong side of the market. And the bad part about that is not only that you end up taking a loss on that trade, but people try to force that narrative, or they kind of hold on to it for too long, if that makes sense. Now, whenever we are looking at the turn or the market from a smart money, whatever you want to call it, perspective, we're just trying to identify manipulation. There's a lot of fancy marketing gimmicks that go into trying to redefine the algorithm or supply and demand or Wyckoff or ICT, all this stuff. It's really just trying to get it, just to not get manipulated and to be on the right side of the manipulation. That's what it really comes down to. And liquidity and not becoming it and using it in your strategy. It all comes back to displacement, or that's what I've figured out at least. And that's the way that I've been able to see a lot more consistency, and also really it becomes a lot clearer for me at least whenever I know exactly what I'm looking for, and not oh, did this candle close beyond it enough, or this and that, or oh, is there enough volume, or this. And really what it comes down to for me is just, is there displacement and is there liquidity taken? So whenever I'm day trading futures and I'm looking for just little scalps, and you can use the same methods on the higher time frames to find bias. That's what I do as well. But when I'm looking, and you're trying to find opportunities on a pretty consistent basis, if you're able to identify liquidity rates and displacement, you're going to be able to find multiple opportunities throughout the day. Um, let me find, I just want to, so you guys don't think I'm just not taking these trades, because I know some of you guys were in stock chat. I didn't signal some of them, but just to show you, there was this one right here, and then I think there was some more posted somewhere else. I'll have to find it, but took a couple trades. Yeah, it was in here, I'm pretty sure, right here. So this was 7:47 a.m., which was on Friday. It was on Friday. Trying to figure out exactly. I want to say it might have been right here. 7:47 when I took the picture, and it had just closed. Okay, so then it is somewhere right over here. So a couple different trades that were taken on Friday, and they're all just using just displacement, right? It's just literally identifying where the market has taken liquidity and then where the opposing liquidity is taken. And you can do this on a higher time frame. You can start on a 5 minute. You can start on a 1 minute. It doesn't really matter. I will say you're going to get more opportunities on the 1 minute than you will on the 5 minute for day trading. But we talked about displacement a little bit and structure in the first part of the crash course. And just to kind of retouch on the main principle there, I'm just going to delete this because it's just in the way. The main principle there is if we do displace above structure, then most of the time we're going to look for the continuation there. And any structure that fails to cause displacement, that we can consider that a weak low, so to speak. So it's kind of similar to the way a lot of the supply and demand courses map structure, but it takes it a little bit more. You can be a little more nimble with it. You don't have to look all the way left and say, oh, this is our strong this over here, and then give this massive range. Whenever we're using this kind of strategy, you're able to see it over and over again. So when we're looking here, if we look at, for example, like this high right here, and we see a big push up above it, right? Now on a 1 minute, it's gonna be a little bit clearer, so we'll go to that. You get a big push up above it, and you fail to close or you fail to displace. You can even close. And this is where it gets a little discretionary. If you want to make it as mechanical as possible or make it mechanical, you can only, pay attention to candle closes. But anytime you see a failure to close above an area of liquidity, you can determine that's probably a liquidity raid, right? And then you wait for displacement and you wait for a shift in structure, and that alone will give you a trade setup. It doesn't matter if it's pro daily bias or not. And this is, for scalping, I'm not saying on the higher time frames, but for scalping, it doesn't have to be pro daily bias. And if you're trying to maybe get more opportunities because you're trying to take a funded exam and you're not getting enough trying to trade just like a 15-minute, 4-hour, this can be super helpful. So again, anytime you take out liquidity, you form some structure, right? You take out liquidity, displace, that in itself, right there, is a trade setup. Now, it may not be the holy grail. It may not be a massive move. For example, right here, the trade setup is just to trade off one of these fair value gaps or the breaker. Now, the breaker in this example is pretty massive. Usually you wouldn't have a big breaker like that. But depending on whatever you like using for your entry model, or maybe you like using the order block here, then you're looking just for the next area of liquidity, which is just the next bit of structure. So again, it can go, right, you have your liquidity raid, right? And then you take out liquidity, you take out structure with force. So we're looking at, it's kind of hard to draw this with, I'm going to draw dashed lines to represent what we're determining as a raid. So this is only if the candle doesn't close or it fails to displace. So that's what this is up here. We'll just draw a smaller push into that area just to kind of depict that. And then you've generated liquidity down here. Whenever you make that first displacement leg, right, a big move down, you expect to at least go back through that one more time. Now, that's where people get greedy and they want to try to target like 4-hour liquidity below or some kind of crazy target. And that's why people aren't able to use these strategies effectively. And they're not always the highest risk to reward. But what I can tell you is if you master this, if you master, again, liquidity raid, a displacement shift in structure. Let me draw this on here for those who don't understand. So there's your shift, right? That's displacement. And again, to those who are newer, I guess I should have started this way earlier. This displacement is it's definitively displacement, a big push in the market that just shows you something's out of the ordinary. Like, this is a move, this is a displaced move, right? Now, I don't want to get ahead of myself, but whenever we take liquidity, then displace, there's going to be a trade opportunity. It's just that simple. Now, that trade opportunity may not be the highest risk to reward. You can see if you're trading here. Now, I recommend using fair value gaps for stop losses like this. You can see it's not really that high of a risk or great risk to reward trade, right? I mean, you get in right here. Now, that's if you take the first fair value gap. It could have been a little better if you take this fair value gap up here. These can be different strategies based on how you trade. I'm not going to get into like exactly which fair value gap to always trade and this and that. 2 to 1 or 1.86 is not bad. Now, a lot of people will say that's too low. You can make a lot of money getting setups like this if you get them every day. And believe me, if you do this correctly, your win rate is going to be a lot higher than trying to wait, months at a time, or not months, I'm sorry, wait hours at a time. I don't know why I said months, but wait hours at a time trying to catch like that move of the day and just trading that one move. Now, that's just trading on one time frame. We can also use the same ideology to confirm higher time frame liquidity rates. So for example, if we go back out to the 15-minute, and you see that we took out all this liquidity up here, and you're kind of just hovering in a liquidity pool. So I'm going to delete all that old stuff and redraw this again. So anytime you take out a higher time frame liquidity pool, like maybe a 15-minute, you can either use a 1 minute or a 5 minute to kind of confirm, because anytime you're up here in this area, that is where there's a lot of liquidity. There's a high chance that we're going to reverse. And you can treat that just like, your order block or your point of interest. A liquidity pool should be a point of interest to you. So, there's a couple different ways people have confirmation models. My favorite is just simple, the same one we just went over, which is the market structure shift. So that's where this trade came from. Here's another picture, the one we just talked about, right? Now I took it a little farther down to that liquidity pool to close in full, but I did trim it that one right there. Now, the trade that we're looking at now from the high of the day, and this is kind of the ICT model that, you wait for 10 a.m. and wait for a liquidity pool to be taken and a shift in structure. Again, you don't have to always just look for this on ES at 10 a.m. This can happen on Euro on a 4-hour chart, and you're confirming a daily liquidity pool being taken. It can happen a lot of different ways. It's just the same formula, and that's how you're going to be successful at trading, is learning how to formulate stuff and not just be a kind of a what is the ICT? A one-trick pony. That's what it is. But the same thing, look, just market structure shift, and then you enter up here. Now with these models, of course, you're not going to just take out all your profit there. Now maybe you do. Maybe you have a really high hit rate doing that. This is a kind of a unique trade because it would have given you good risk reward doing that. You do not get 3 risk reward usually from that. You're not. Just not on ES. Usually it's going to be much lower if you were to target that first pool. But you can then target opposing liquidity on the 15-minute, because again, remember, if we're kind of trying to confirm that this is a liquidity rate, well then the opposing liquidity is going to be taken. So where is the closest opposing liquidity? It's going to be right here. And you don't have to go for all the way down here, and this is where people get tripped up, because they look left, say, okay, and this may have worked, this time. You can say maybe I'm going to take it all the way down to premium, or I'm sorry, to discount. But again, the model that I want you to focus on is just getting the low-hanging fruit, getting the next stop, because again, we're trading, and this is pretty common sense. If you want to get the best trades, you want to catch the higher, or I'm sorry, if you want to get the best shorts, you want to catch the lower high and target the next lower low. You don't want to try to get here and hold it all the way down to there, because that's how you end up having this happen to you, and you just lose all your money, or not lose all your money, lose all your profits, and never really consistently chip away at getting to your funded account, or getting to that payout, or making money on your personal account, whatever it is. The way you do that is just by kind of extracting money from the market as it's made available. So in this example, you could have just traded that displacement down, waited for the return to the fair value gap, or again, there's a lot of different ways you can do it. Break or entry wouldn't have been the greatest here. Would have got you worse entry than anything, really. You would have just traded from right there. There's also the order block right here. And then, of course, we have a fair value gap. And then you also have a balanced price range if you want to look at it like that, which is basically just one fair value gap and then another one trading right through it. Those are usually kind of signifying a liquidity raid again. So here was another raid. So there's a lot of ways you can look at it. But again, it's just really all revolves around displacement. It's just that 2 steps: liquidity taken, displacement. Trade that alone always will give you a trade setup. Now you're gonna have to look for the higher time frames if you want to get longer profit targets, but you don't have to always do that. So another one that I took here And this is an example of just using displacement kind of as a confirmation, I guess, if you will, or what are we drawing towards. So here it was late in the day. It was right around 3, it was almost 3:30. And I looked at this. Actually, I think Vanch, I think I showed you this. We were talking about something else in the DM, and I showed you this right here. But oops, wrong thing. But you can use displacement not only to get into trades, right, but to identify what the draw on liquidity is right now, right this second. Now, not the final target or not, because obviously we went much higher. But if I'm watching the market right here, let's just say I'm right here, and I see the price trade back above this area, which I'm presuming to be a breaker block because it came down, formed that short-term high, and then we took out liquidity here, and then obviously the market didn't make another high before taking out more liquidity down in this area right here. And then on top of that, if you look at the 5-minute, that displacement from right here up to there, that's kind of our dealing range. So again, you have a bullish dealing range. When we come down to a discount of that, we look to target the highs. If you go on the 1-minute, you're coming up above this breaker right here. And the 5-minute's a little clearer too, the displacement overall. On the 1-minute, you're coming up above that breaker. At that point, if we're looking at this from a market maker model perspective, you shouldn't go back below this because this is going to be your, let's see if we can go on to the 30-second. I'm not a 30-second trader, but just to show you guys, to spread this out a little bit, you've got your original consolidation, right? Your run down to support, smart money reversal, and then after you come back above that run to support, or if this was a bearish market maker model, your run to resistance, you shouldn't go back below it. So you look for some kind of point of interest to catch. The silver bullet is kind of what they're calling it. And I think that's like the morning entry is what they're referring to, but it's the silver bullet is just the last leg of a market maker model. Now, sometimes you get better risk reward than this. And if you're wondering why I put my stops right there, it was just because it was the bottom of this whole little buy to sell range, that whole breaker. And again, on the 1-minute, this was the breaker, right? But I'm marking it all because price is fractal. So I'm looking at this whole range right here. If you go on maybe a 3-minute or a 2-minute, it's probably a breaker. There you go, exactly. But I just kind of look at things like that whenever I'm already putting a really tight stop loss, because a $2 stop loss on ES is not much at all. But again, I just use displace in the 5-minute to kind of get the bias that we're going to go higher, right? Because we're going up, we went up, back down to discount, we're going to go higher. And use the 1-minute to kind of tell us, okay, where should we not go back below if this is correct? Because if this is a market maker model, once we get back above this area right here, then we should not see a retracement below it. So at that point, you can I'm trying to explain this the easiest way. I know it's probably confusing, but I want to get into some of the more advanced stuff. And I think this next week, either this week or the week after, I'm going to do some live trading stuff with you guys, just like scalping like this, because it's became a little bit more like my newer trading style, especially with the Top Step account, and just being able to trade on TradingView makes it super easy. Hopefully that made sense. But you can see that all this revolves around displacement. Because again, if we didn't have displacement here, that wouldn't tell me that that 5-minute expansion's in place. And I wouldn't be looking for the 5-minute expansion if we didn't have this move right here, right? Liquidity being taken, displacement. You see what I mean? So it's just that same mental model over and over and over again. And you have to be aware of where you're at on the higher time frames in order to be, consistent with it. But in order to get setups, you don't necessarily have to trade. People say like, okay, the 4-hour, I'm gonna wait for like the or discount the 4-hour. I'm gonna wait for this, and come down here, and I'm gonna catch here, and then I'm gonna do a 5-minute, 1-minute, 15-minute confirmation, and I'm gonna get this. It's just like you don't have to do that, and that's not sustainable over the long term. I've yet to meet somebody who's doing that with live funds. I have never seen it. I've seen a lot of people try it. I've never seen somebody that consistently does it, unless they're risking like 0.1 or 0.2%, and then it's just like completely pointless, because I think that anybody could agree it's much easier to get 2 to 3R consistently and risk 1% than it is to get 10R risking 0.2%. So and this is just coming from a long time of trying different things and seeing what works most consistently for me, and everybody's different, but that's my thought process on that. look at Bitcoin recently as well, because Bitcoin is another good example. I know ICT, I think, said like 36. Oops, wrong. Dude, ICT is hella late. He said zero, and we were saying like 25K. He was literally saying zero down here. I remember we were like in this area. He said zero, and we said 25K. He waited till this. That's funny. He called it now. It's like, okay, Captain fucking obvious. But and again, this bias is from displacement. It's just the same thing. Just and this is where a lot of people get caught up in looking left. And like you do need to be aware of that. Like right here, this is our range, right? That's our weekly range. But and this is where the strong high people will draw all the way up here, right? But I'd look more like, again, displacement. Where do we really start displacing from? Right here. Where do we consolidate down here? And this is kind of, that's just the way that I look at it, because I see more value in areas that have a big level of displacement from it. I said can't hear. I think that might be just you. Can somebody else confirm? Unless it might be me, I don't know. Okay. Copy that. But yeah, I don't know what to tell you, Andy. Oh, you can't hear me. But yeah, and this can all be told displacement too. Like again, whenever we're looking at where is the market, draw on liquidity, all this complicated shit, it all comes back to displacement and liquidity being taken, right? So again, like this area right here, this was a tricky one. This is one I wouldn't have really called, but I see it now in hindsight. I don't want to give off like because I would have told you guys this. Obviously, we were waiting for a retrace. Oops. So we said displacement here. I'm sorry, a liquidity right there, and then I wouldn't have called that displacement. I wouldn't have, but you see that it worked out nicely. Now, what I would call displacement is this right here, what we have already. So now that we have that bias, obviously right now the market's drawing up. Right, where is it drawing to? Most likely these areas of liquidity right here. And that's going to be right resting in a premium of what I've drawn as the weekly range. A lot of people maybe I guess would draw this as a daily. I don't know. Because I know that back whenever I used to first map structure, I used to look way too far left. But really what you need to look at if you're day trading is this right here. Now you need to know where you're at. I get it. You need to be aware of it. But once you understand this gives a lot more opportunity and a lot more clarity, right? And whenever you look at, okay, where are we displacing from? What kind of, what was the initial push that caused the big, break of structure? And sometimes you have to go down to 4 hour to see this. Like we look at a daily, we draw right here. That was our shift. So let's draw, or not, you could call it a break of structure, I guess. Oops. It's a break of structure, the continuation. But anyways, we'll just draw that line. And you go, if you 4 hour, look at that. We have a fair value gap that caused that displacement. And also, if you're an OTE guy, basically OTE. So once we establish that, what we're going to look for is price to potentially come down here. And then once you're in that zone, any raid at all, and displacement following, that leads you to look for the high. Now, oftentimes what's going to be found within this is a market maker model. And then you'll start to notice these things repeat themselves over and over again, but you don't really start looking for them until you have that two-step process of a liquidity rate and subsequent displacement and structure being taken. Just that alone, that completely changes the way you look at all your different points of interest and all this, because so many people will try to again, try to min-max everything, but really, in order to make money consistently, you just need to, your bias has to be right. Once your bias is right, it's just a matter of not trying to get 150R every range, just extracting money from the market when it's made available to you. When is the money made available to you? When you understand where the market's going. It's that simple, right? The lower time frame stuff's easy, but I don't want to keep beating on a dead horse, but I hope this helps a lot. That's pretty much it for today's class. Pretty short, I know, but again, I can say the same thing 100 different ways. It's not going to really make it sink in anymore. So if you guys have any questions, type them. I won't be able to hear you. Maybe I can. You guys probably can't talk anyways. But I'll start doing the classes in early birds because I know that. Can you get, for those of you who don't have the stock section, can you guys still see early bird stock stream, like that voice channel? Because if so, I'm gonna start doing them there because I want you guys to be able to talk. This makes it easier for me. Oh man. Okay, somebody said yeah, so I'll start doing them in there next. I say that and then I forget. I'm not sure why it's so. Somebody said any tips on playing liquidity rate model? Nothing more than what we just went over. Just treat it like anything else because it's like trading. Trading smart money is a two-step process. It's well, more than two steps, but when it comes down to your entries, it's a two-step. It's like you have your trigger, which is maybe you took liquidity, maybe you're in an order block, etc. And then your displacement, shift, and structure. Now another entry I am working on, I will say, is a turtle soup model. So for those of you, it's basically trying to know when to buy the stop, so to speak. But I'm still working on it. And then a second entry model I've been working on is something like, let's go to ES because there's one that's, I'm going to see if it works. Don't go try to trade this because I'm not going to trade it. But anytime we have a liquidity rate model, like if liquidity is taken, don't use this for anything except that. I'm still testing it, but anytime you have a balanced price range. So like, let's say, here, let's do this. Let me see if I can, let me see if I can do something. So let's see, like let's say if well, you took structure. Let's say imagine that you hadn't taken structure right there. Anytime you take out a liquidity pool, like let's say if liquidity was taken from up there and you hadn't taken this structure, if you have this balanced price range, you can trade that, or well, I don't say you can. I'm trying to figure out how to trade that before you get a shift in structure. Because basically it's kind of like trying to catch a move when you have a really sharp push into your liquidity pool, and then like let's say like if this were a 1 minute, right, and you got your shift in structure, but you never really got like a retracement into it. I've noticed that a lot of times, as soon as that balanced price range is formed, not even waiting to trade into it, but as soon as it's formed, that could be a confirmation too. But again, I'm trying to refine that. Mark Douglas, yeah, for books. Jared Tendler, that the mental game of trading is actually really, really fucking good, man. It's a really good book. It's a kind of like a nice take too. It's a little different than Trading on the Zone because most trading psychology books are just like rip-offs of Trading on the Zone. But Disciplined Trader by Mark Douglas, Trading in the Zone. There's one I read a long time ago. What was it? The Zen Trading. That's what what the fuck? I swear I was just trying to say the one I read a long time ago was Zen something. But Sounds good. Yeah, that I read that one a long time ago. So I can okay, so I'll go talk. I guess because it's your green name. Yeah, I'll drop the link for it. Hell yeah. And sorry if there's echo. My fucking quadcast fucked up like my HyperX. They don't even have drivers for this mic, but I'm about to just go to Best Buy and buy a new one. I need to get a camera too, anyways. You should get a mixer though. What is it? A mixer? Like in the studio. Oh yeah. I thought you meant like a brand. No, you get it for like what, like $100? Like what? Like would that like so I could basically plug in? Because right now the issue that I'm having with my fucking HyperX is it's just saying USB not recognized. Like, and it's always fucking up. Like it always just kind of like unplugs itself and plugs back in. Like whenever it's just sitting there. And then finally today it just shit out. And basically, like, it just won't detect. Like, and then I tried to open up my device manager and tried to reinstall the drivers. There are no drivers other than the basic ones. You can't find them on their website. And, yeah, so I'm just kind of like, fuck, I'm just going to buy a nice one. I want to get a Sweetwater Sound, like the SM, it's like the one that most major podcasts use, SM7B. Yeah, I use the blue.
Blue one.
The Blue Yeti.
Yeah, the Blue Yeti.
That's what I was thinking about. Because the one that I want, they don't have anywhere, and I need a fucking mic. Like, I can't wait for like a warranty. I have to have it. Like, I use it almost every day.
Yeah, you should do the Blue with a mixer, and then that way it's for.
Yeah, like a Elgato. Are Stream Decks technically mixers? Because I almost wanted to buy one of those.
I think so.
I know they're like it's like I don't know if you can actually really do anything with them except just like link to your Streamlabs and shit.
So no, I hate the Stream Deck.
It cut out a little bit, but I think you said it's not a mixer, which I think
Yes. It's just a sound.
Yeah. Yeah, I was thinking about getting a Blue Yeti.
Mixer, bro. You can have Casper rapping and everything.
It's like, all right, guys, with no stream today, we're all just gonna do freestyle. So we put on type beat.
Hey, Blue Yeti's a USB mic. Oh shit, but you gotta be careful with the voltage. That shit burnt out my laptop.
So that's probably what I know my fucking I have like all USB 3s on my PC because I thought it was maybe like my USB ports, but it's just this fucking mic, bro. That because the HyperX and the Blue Yeti are like the same thing. They're like the same price. Basically, whenever I did all my research, everybody's like either HyperX or Blue Yeti. And I got this one just because I like the way it looked better, which is kind of dumb, but I mean, shit, whatever. Um, but it's just like I don't understand how it fucked up the way it did, but it's just literally like just shit out on me. I don't understand. I'm gonna try to mess with this some more before I just buy a new one.
You got condenser mics as well.
Yeah, the one that I was looking at is the SMB7, or I'm sorry, yeah, the SM7B from Shure, SHURE. But it's kind of like it's like what most of the major podcast type shits be using it's the fucking mic that Michael Jackson used, but like their modern version of it. But it's like they make it one for like podcast. They're like $400, but I'm like fuck, bro. And I'm gonna spend 100. I spent 160 on this piece of shit. I've had it for 6 months. It's annoying. It literally unplugs itself, plugs it back in, and all this fuck shit. I'd just rather spend $400. Not have to, because now I'm gonna have to fucking go to Best Buy. Hopefully they have what I want. Get in touch with, like, bro. I'm so like, bro. I don't have time to do that. Like, yeah, sure, I can contact them and get warranty and have them send me a new one. And it's like, so I said, have you tried hitting it a bit? That's awesome. I'm definitely gonna resort to that. Just fucking throw hands with it.
Have you tried turning off and off your?
Oh, bro, I did that kind of shit. Yeah, I fucked with it for like 20 or 30 minutes before the stream started. That's why I was late. That's why I had to make it late. I'm gonna teach it a lesson, huh? So I'm gonna beat the shit out of it. But it's basically like, so when I plug it in, I looked it up too, and apparently these mics just have this issue, and some people can fix it, some can't. When I plug it in, it says USB device not recognized. The last time you connected this to the computer, it malfunctioned, and da da da. I see your question. Hi, sorry, my bad. So for a 4 hour, I would do 15-minute. If you're trying to confirm the 4 hour, then I would do the 15-minute for sure. I wouldn't jump down to that. So okay, so basically, 4 hour to 15-minute, 1 hour to 5 minute, 15-minute to 1 minute. Daily, I would do a 1 hour or 4 hour. 1 hour is a little more aggressive. That's what I usually use. And then to confirm a weekly, I would do it daily. Let me know if that clarified that. Sorry, I didn't mean to. I kind of forgot your question, or not forgot. I saw it, and then I was talking shit about this mic.